Up next, we're bringing it home with Aspen, which is a significant global pharma company supplying branded and generic pharmaceuticals in more than 150 countries across the world.
Yeah, and it is, in fact, one of the South African companies we're most proud of. Stephen Saad, CEO, founded as recently as about 16 years ago and grown to a sizable player on the global pharma market.
Market cap is 160.8 billion rand, PE of 34.3, dividend yield here of 0.6%. Talk to me about Aspen.
PE a bit out of my range, to be honest.
No ways.
Yeah, I promise you, I think it is. And look, they've done really well. The market cap is absolutely amazing. It's
At
phenomenal.
160 billion.
Exactly, for a 16-year-old. But I mean, honestly, can you ask anything else? But I'm more worried about two aspects. Well, I think first and foremost, pharmaceutical goods in South Africa are very expensive, and we know what they do. These medical aids, I know they pop it up and it goes even further. And this guy's success has been behind that model that has worked. With the NHS going to be introduced, will they be at an advantage? Yes, I agree. I think they'll have even a bigger pool of clients to service. But most importantly, how does the business grow from where they are now to maximize when there's such really tough competition in this particular space? I'm talking about the South African leg of that. I don't know. I know that the production lines, for example, with the generic stuff, they buy it for a very cheap price, for example, and that's why they can buy it in masses. So that is incredibly well. They've done that very well. They do pay dividends, but the PE for me at 34, guys, I'm sorry.
But you have stomach for this PE at 34, Paul?
Yeah, I didn't worry too much about that, and the reason is Aspen is in transition. You know, it was a South African leader and it got a big market share and it did generics here well, then it went to Australia, but now it's really going into the global first division. And what Stephen Saad has done is to raise a lot of money in Europe's credit markets, where you can, you know, pick up all sorts of money at very low interest rates. With the help, obviously, of investment bankers. And he's applied that to buying key strategic assets from European drug makers that are either tired or marginal or ex-patent. But for these big players, it's really not really a big deal. They've been very happy. So that's Merck, which sold that whole line of heparin-based stuff that you use for anticoagulants, like if you've got blood clotting issues going on. And then this deal in the last week, where we saw the share price shoot up 10%. That came from a deal with AstraZeneca to buy a portfolio of anesthetic drugs.
Is the Glaxo overhang out of the system?
I think so, because really, remember, Glaxo did a deal where they gave them the South African business that Glaxo had in exchange for shares. They had 18%. They reduced that in 2 tranches down to 6%. So it's not really a big factor anymore. And it's removed the overhang, I think, effectively. People can now see their way past that.
I think it still hangs. I think even the way the business still operates, it still operates in a similar manner. But what they've done very well is become a standalone competitor, which before, obviously, it was hard because it looked like they all looked the same. But now, all of a sudden, they have had an edge. And, I mean, you can't complain with the kind of market cap that they hold.
Let's just look at the share price graph.
So it's getting a move on again. I'm wondering about that share price graph. That doesn't look right at all. We'll have to redo that one.
I wish it was trading.
What you'll see in the share chart is that it'll go all the way up to like 400 rands a share about a year and a bit ago. Then it falls off quite precipitously. Lately, it then gets a nice move back up again.
But it's not trading at all-time highs.
No, it's not. Look, the all-time high, I think, was close to 400 rand a share, and we're now sitting at around, in fact, it's more, 430. And it's now sitting at about 360, having had a bit of a slump all the way back down to 280, 290. So it's on the way back up again.
Still too expensive for Clive. Hot or not?
Not.
Hot or not, Paul?
So it doesn't pay much of a dividend yield, and it is on a high forward PE. But remember, this deal that they announced now brings an additional $100 million of profit to the bottom line based on the prior projections. And the funding, as I said, is very cheap. So I think what's emerging here is a real player on global stage. And Stephen, as we know, is very good at buying and very good at reorganizing the assets.
You're almost asking us to give them a little time to rework themselves into this global player and do the deals that they need to do to offer value.
Well, what about now?
Paul's not about today. He's about tomorrow.
He's about tomorrow. Okay, fair enough. But if you were to be asked, if you were to hold a gun to my head and say, "What do you do now?" and I'd say, "Not hot." But if you want to heat up,
if you're holding it, what would you do? If you're a holder, just say you were a holder of Aspen.
I would hold.
Would you hold?
I would hold. I would hold, but I won't buy anymore.
Because the point here is that they have disappointed before. We know that in 2014 they did a lot of
Yeah.
deals and then they didn't bring the profits quick enough, and so the market got a little bit huffy. But I think we're now in a situation where what was bought in 2014 is really starting to fire up, and the global distribution issues are sorted. So this is a nice bolt-in deal, definitely hot for me.
Definitely.